The FDIC is a government agency that insures up to $250,000 in individual deposits in the event of a bank failure. Now, for most of us, that's reassuring, but for wealthy investors and big companies, that's chump change. And after having no bank failures the last 2 years, 2 banks have already gone under in 2023. Thankfully, they're not in Oklahoma. But how safe is your money during this volatile time? That's the topic of this week's in-depth discussion with moderator Reece Wetzel and his panel of guests. Reece.
Thank you, Rich. Today I am joined by 3 guests who can really give us some information on this banking crisis that's been going on and been in a lot of headlines recently. I want to introduce Governor Frank Keating, former governor and former president and CEO of the American Bankers Association. And then we have Priscilla Cude, President and CEO of the First Bethany Bank and Trust in Bethany, Oklahoma, and she's also an Oklahoma Bankers Association board member. And then we have Dr. Travis Roach, Associate Professor, Chairperson on the Department of Economics. He's been with us a few times over here at UCO, so thank you for joining us.
Yeah, thanks for having us.
Well, I just want to get right into it. Governor Keating, ever since the shutdown of the Silicon Valley Bank and the Signature Bank, there's been a growing fear, a growing worry that this could happen in Oklahoma. Is that a reality or is that just a fear?
Well, bad things always can happen. There's no question about that. But I think we have a very active state banking office, even though perhaps that entity doesn't oversee or regulate you. But for example, a state chartered bank like Bank First, and I'm on their board, has the state banking regulator and the FDIC, so you do share intelligence and ideas and the like. But the impression I've had in Oklahoma, certainly after Penn Square, is that Oklahoma is much more focused on making sure that our depositors and customers are secure, but a bad thing can happen, just like, how many people ever would imagine Silicon Valley Bank in Silicon Valley, the center of the centerpiece of wealth in America, would be jeopardized, and it was mightily jeopardized because of a number of very bad things that happened as a result of the absence of regulation and behavior. But that's life when you're dealing with your own money or sometimes somebody else's.
Yeah, of course. Now, we come to the next point, and I want to go to Priscilla for this. We're talking about a lot of publicly traded banks, and most Oklahomans might not know that a lot of the banks in Oklahoma aren't publicly traded. So how is this affecting these smaller community banks? Is it having any effect on them at all?
Well, you're right. Oklahoma has a handful of publicly traded banks, so most of the banks are privately owned community banks. We're seeing, everybody sees the headline news and all that, but the Oklahoma banks are very strong. They're very well capitalized. They're very conservatively run. So we don't seem to have the problems that some of these banks on the West Coast have had. We don't have the concentrations that it appears that these banks have had. And so I think that makes a big difference as far as just the business model of who Oklahoma banks are versus the Silicon Valley and the other banks that have been the headline news.
Yeah, and I know that I was reading that a lot of the startups in Oklahoma are funded a little bit differently than they are out on the West Coast. Does that have a factor in how that plays?
Well, I'm sure it does, and I don't want to speak necessarily. I'm not an expert on West Coast banking, but in the case of Silicon Valley, these banks, they had a lot of venture capital equity that brought them up, and these equity funds were also depositors of Silicon Valley. We're talking depositors that have $800,000-$900,000 in a deposit there.
Wow.
And that's and I've said thousand, excuse me, $800-900 million.
Wow, that's an even bigger wow.
Yes, I mean,
that is a large figure.
Yes.
That is unheard of in our state, in our size banks.
Yeah.
And so as far as startup businesses, I think a lot of it is through family and friends, some banking. We have incubators in the state that help on some of those but certainly not to the size and the degree that you see on the West Coast. It's Silicon Valley. We all know about the tech industry.
Yeah, and that makes me want to turn to Dr. Roach here. We're talking about a lot of money being put into one bank. And you had brought up when we were talking just before this, NBA player Giannis Antetokounmpo put his money in 55 different banks. So is it just bad investment? And at that point, when do we stop bailing out people who make risky investments?
Yeah, so we should differentiate risky investments from where you're placing your money and can assume that it's safe. It is better financial risk management sense if you have such a large deposit to spread that across several different banks, because the federal government, before last week, the line in the sand was $250,000. And we had deposits that were well in excess of that. Now, in normal circumstances, a bank is okay with having depositors that are in excess of that because they can balance that with a lot of smaller deposit accounts. So the proportion of their entire client base isn't over 250,000. SVB was a very strange situation where the vast majority of their clients were above that threshold. So we get that issue. And then at the same time, what they did with that money is really what caused SVB to go down. Most banks will take the money in and they'll turn that back out into a loan to another business or a home loan, whatever that might be. SVB was putting a lot of their money into the bond market, into securities, well above the median bank of their same size. And so it became this balancing act between assets and liabilities. And at the end of the day, most banks can stomach some kind of, let's call it down economic times, having some financial stress. But when all of these depositors come in, because they fear their money is not insured because it wasn't, that's what causes this contagion effect.
And I think the commonality of your depositors, customers, directors, stockholders suggested everybody was going to move in the same direction, which is not necessarily healthy. And that occurred, and there was no chief risk officer in that bank for the last year, 12 months. And you would think somebody would see, because of these dramatically increased interest rates overnight, that there would be the potential for a run, the potential for a crash in value. And apparently that just didn't dawn on too many people, largely because there was nobody watching the watchman.
Yeah, and if you're an economics or finance major at UCO, you learn this in some of your first classes about interest rate risk and what the Federal Reserve does when they're trying to tighten monetary policy. Interest rates will increase. This was known to everybody. This was as forecastable as anyone could think, and you'd expect that some of these bank executives would be able to see that coming. One other thing we should add to this is that we recently repealed most of the Dodd-Frank bill that regulated banks, especially of SVB's size. They used to undergo what were called stress tests, and they lobbied Congress saying that this was too burdensome of a regulation to come up with or to handle. And we're seeing, I'm not here to say that were there stress tests, this doesn't happen, but that is the kind of question that gets asked in a stress test is, how will you deal with a rising interest rate environment? This question was not asked because the Dodd-Frank was repealed.
What was it, $250 billion, which is a very high figure. But my understanding, I may be wrong, I was never a regulator, but my understanding is they permitted, because basically you were muscled, like if you're over 100 billion, we may take a look at you. And apparently everybody was silent. I suppose everyone thinks that whatever comes out of Silicon Valley is wise and wonderful, and that simply was not the case here.
Right.
So I want to bring up, kind of stay with you, Governor, about this. Is it an issue of too few regulations or too many regulations? I know you're saying that maybe things were overlooked or just weren't paid attention to at all. So would that be in regards to some of the stuff that's been repealed and pushed back against the banking industry?
Well, the underwriting, who knows? If you're making the same loan or a similar loan to a whole class of people in the exact same business, I'd be worried. I mean, it's nice to have diversity in terms of your deposit and customer base. The jury's still out. Obviously, you're going to have the FDIC, you're going to have the Federal Reserve, you'll have a lot of political people, you'll have academics looking at what occurred. But I would assume one of the problems was it was a go-go culture, not dissimilar, I hate to say, to the culture of Penn Square Bank, that we could never fail, we could never lose, and we did big time.
I think you also should kind of differentiate when you mention is it regulation, that there's regulation, but is it enforced? And the question has been, from what I've seen, is it didn't seem to be enforced much in that area. I know my bank, when we are examined every 18 months, that diversity always comes up. They want to see the reports on that. They want to see uninsured deposits. I mean, all of that's reported, all of it's looked at. So to the governor's point, it's interesting that they let that go by. The regulation's there, and but for whatever reason, it wasn't examined much. And you kind of wonder, is it the mentality of this is the tech industry and it's go. I don't know, that'll come out, but
Yeah, and today, March 22nd, Dr. Roach, we're looking at maybe the Fed raising rates again today. What do you see happening if that does happen?
Okay, so we're back to the good old days of not knowing what the Fed is going to do. Almost my entire professional life, they've been saying what they're going to do with interest rates with flashing bright lights. They call it forward guidance. But we used to watch, for instance, Alan Greenspan used to show up to these meetings and they would try and judge based on the size of his briefcase at that point, like how much paper he was bringing to justify a rate increase or not. We're taping this on a Wednesday. This will air on a Friday. I have no idea what's about to happen to interest rates. I think the betting money says a 1/4 point interest rate increase, which is there to, help us with this inflation issue that we keep fighting off. And the Fed, what's nice is they have multiple policy tools that they can use. In this case, they're providing liquidity to the markets because that's the big concern with a bank run, is that it becomes a self-fulfilling prophecy, that you see a bank run and you worry about your own money, so you go do, and it sucks the money out of the system. The Fed is very active and currently doing a good job of providing liquidity to tamp these fears down. They also have to still fight off inflation. So I expect that they raise interest rates at least by a small margin today. I don't expect that really changes economic outlooks by much over the medium term. Let's say it does raise interest rates a little bit. That changes borrowing and lending. But again, this is all with the goal to bring down inflation, which I think we're 8 months into slowly ticking down inflation. They are slowly getting their job done. And so ultimately, that's a good economic signal.
So
what was our ceiling? Inflation ceiling anticipated, we don't want to go any higher than 2%.
Right.
And where are we now? 5-6%. So that's still a bunch.
Sure.
And to say I'm going to do a 1/4 point so that you all know I'm serious, I have a belt in my hand, so behave. Maybe that'll work, maybe that won't work. But I think the sensitivity to the volatility of money is still very much out there as a result of the collapse of this very large bank. I think they'll probably try to do both. Assure people that we're going to protect them, and also we're still focusing on inflation and employment reports. That's what they're supposed to do.
And I'd like to point out, as far as Oklahoma banks and where does this stand, and you're right, the Fed's doing a good job of liquidity in the market, trying to keep runs. For Oklahomans, you go back to FDIC insurance and we say $250,000 per deposit, but it's really per deposit category. There's a lot of ways to structure FDIC insurance where you can have over $1 million pretty easily. There's a website out there that can help you. Most bankers, all my bankers know how to use it. We help our customers all the time to learn how to structure. There's programs in place so that Oklahoma bankers can help you keep your money insured without having to worry about, am I going to lose it?
Well, Jill Castilla has been with the bullhorn, letting everyone know their money is safe. And then, hey, by the way, if you're worried, here are these other great options you can do.
Yes.
And we're talking about being insured, but that brings up a good point: is who is and who isn't insured. Anyone can take this question here, but how do you know that you're going to be insured if you're putting this money into a bank?
I'd say talk to your banker. That we're a relationship-oriented business, and so you talk to your banker. They'll help you through that. They'll show you that.
And what's the average estate in this country? Certainly Oklahoma, a slide down from that figure, it's like $200,000, something. And, you and your spouse, that's $500,000. That's a lot of money for anybody, anywhere. But I think it was stunning. Maybe more, J.B. Morgan Chase and Bank of America have clients of the numbers that Silicon Valley has, where they would just dump 7 figures into the bank. That really surprised me, to be honest with you. I just had never seen that.
Yeah, I mean, a lot of shocking news coming out of this situation. Unfortunately, that's about all the time we have. I want to thank all of you for being here and for taking the time to be a part of this panel. There's a lot that's going to change, so we're probably going to have you guys back.
It's a moving target.
There's no telling what it'll look like even here just in a few hours. So I would just once again like to thank you guys, and yeah, thank you.
Thank you.
Thank you.